It's a really great pleasure to be here. I've been to Israel. This is my fourth time. First time I came was in 1975. I was working with an Israeli economist named Dan Landau at Haifa. And that's the first time I came. And I've been back a few times, and usually it's been the time since then, Nathan Sussman was involved in me coming. Great to come back here and see you people, and it's nice to get away from winter too, so I appreciate the invitation. This talk was a talk I gave to the Economic History Association in September. I was president of the Economic History Association, and it's kind of it's an overview kind of paper. Okay, it's based on a lot of research that I've been doing with a lot of people for a very long time. So what I do is I'm looking at the evolution in history by the last 2 centuries on the connection between the monetary regime, which I define as the exchange rate regime, and the monetary policy regime, and financial stability. And macroeconomic and financial stability are very important for economic growth and development. So it really fits into the mainstream of economic history, because these public goods are provided by the macroeconomic policy regime. And by macroeconomic stability, I mean price stability and stability of the real economy. Now, financial stability traditionally meant preventing and managing financial crises, and that used to mean basically banking crises. But it's changed. The sort of notion of financial stability has changed in recent years, and it's thought of more as heading off systemic risk. And I'll sort of define my terms more as I go along, especially today they talk about credit-driven asset price booms. So just to sort of give you the overview in my intro, and then I'll go into the details. I talk in terms of an exchange rate regime. That sort of sets the basic framework, and I've done lots and lots of papers over the years on this very topic of exchange rate regime. So there were sort of 4 regimes in history. The specie standard, which meant bimetallism and gold. We can push it back before then to commodity monies, and that old paper I did that Nathan talked to was basically about silver and gold coins. And that also includes, under specie, include the gold standard up to 1914. And then the second one is sort of a gold exchange standard that prevailed in the interwar period. And then the Bretton Woods adjustable peg system after World War II. And today we're on a managed float and basically fiat money. Okay, and within this exchange rate regime, we can talk about these what we call monetary authorities. In the simplest term, it's central banks, and they follow a monetary policy regime. And that's really the same as what monetary economists call a reaction function. It's the relationship between monetary policy tools and goals. And the tools have been traditionally a policy interest rate, that's what central banks look at today. Monetary aggregates, they looked at 30 years ago. And then other stuff, qualitative and quantitative controls. And the objectives of monetary policy have changed over time. So before World War I, it was exchange rate convertibility. It was being on the specie standard. And then after World War I, 20th century, it becomes the things we know about: price stability, output stability, low unemployment, and financial stability. And so within this story is the history of central banks. And I've been working a lot on that topic in the last few years. And they evolved from the 17th century. The first one we talk about is the Riksbank in Sweden, and then the Bank of England in 1694. And these institutions, they first were associated with financing government, providing finance to government in wars. Then they evolved into bankers' banks, banks to commercial banks, and then to a lender of last resort. And then in the 19th century, they involved in managing the gold standard and maintaining convertibility. or we can think of it today as exchange rate, monetary, exchange rate policies, and to providing macro stability. And there was this learning process through history, but it wasn't linear. The process to establish monetary stability was long and painful and non-linear, and it followed kind of a pendulum process. There was a period of success in the 19th century, then failure in the 20th century, and then back to success. And sort of the Great Moderation, the period before the financial crisis from the mid-'80s to 2005, was viewed as the pinnacle of success. But the same story of evolution follows from financial stability. It was also a long and painful process. And it took countries' central banks a long time to learn how to be lenders of last resort. And there's a whole history of how the Bank of England was first and all the others caught on. And I'll talk a little bit about that in my talk. And then what happens is that after the Great Depression, we adopt a financial safety net. And the banking panics that had been really a big problem in the Great Depression, in the US and a lot of other countries, they were, in a sense, resolved. The problem of banking panics was sort of resolved by A, central banks learning how to be a lender of last resort, and B, a safety net, deposit insurance. And what that meant was that the crises that have occurred in recent decades are not the old-fashioned banking panics where guys are lining outside the banks, but fiscally resolved banking crises, bailouts. You had one in Israel here about 20 years ago. And also there's supervision and regulation, which is an important part of central banking, and that went through a lengthy learning process. And what comes out of this history are four key principles: the history of central banks, the importance of maintaining credibility for price stability or low inflation; secondly, maintaining real macro stability; third, providing credible rules-based lender of last resort; and finally, having a sound banking structure and effective supervision and regulation. So these four principles come out of this evolution story, which I'm going to tell you. And now what happens is, and I'll sort of summarize this slide, there's a lot to read here, is the global financial crisis of 2007, really changed perceptions a lot on this connection between the monetary policy regime and financial stability. Before the great financial crisis, central banks were advised to be a lender of last resort and not to prevent asset price booms and busts from happening. But if there was a mess, if there was a bubble of some kind or a boom bust, you clean the mess up later. That's called cleaning. But since the great financial crisis, many people have argued, at the BIS especially, that the real reason we have crises today is because of credit-driven asset price booms. And that what monetary policy should do, central banks should do, is to use their policies to head off the imbalances in advance. And that's a policy that's called leaning against the wind. But also that central banks should use other tools of macro-prudential policy, like regulating loan-to-value ratios and capital ratios, to prevent imbalances from becoming serious. But there are other people out there, me included, that have argued that if you do that, then you're going to conflict with the other main goals of monetary policy that I outlined in the previous slide. And that could also encroach on central bank credibility and independence. So in a sense, my talk is taking an historical perspective on this big policy debate that's occurring right now in every country. And so, so I argue, and I've always argued, as Nathan said, that you got to use the lessons from economic history when you want to resolve a big policy debate. You got to really look at what's been done in the past. And one big problem with central banks everywhere and most economists is they don't look at history. And they take a problem, recent crisis, that's the new world starts now, stuff that happened a long time ago is of interest to historians, but they really, you know, they're not important. So I argue it's very important. And so what I do is I survey the historical evolution of monetary policy and financial stability. Then I look at some evidence, empirical evidence that I put together with others on the incidence, the costs, and determinants of financial crises. And then I tell some stories, and if I run out of time, I might cut corners here on some famous financial crises from history, but I have some nice pictures. And then the fourth thing I do, which is novel, okay, is I look at some simple evidence on the relationship between credit booms, asset price booms, and very serious banking crises. Okay, and what I get, the main takeaways that come out of this, is that financial crises have lots of causes. And credit-driven asset price booms can be one of them. And they become more prevalent in recent decades. But that financial crises are very heterogeneous and they're hard to classify. And I think that point, heterogeneous, is one of the main takeaways from here. Okay, that there's no simple story when you're talking about financial crises. And then if you look at history, there are two key events that stand out, two key episodes in the record of serious financial crises, and they happen to be linked to credit-driven asset price booms. The 1920s and 30s, Great Depression, and the global financial crisis of 2007 to 8. And so then the question arises, I raise, is these were, we can call these two episodes as perfect storms. Should they be grounds for permanent changes in the monetary and financial environment? And I raise some doubts, okay? I'm not saying I don't think they should, but I wanted to raise some skepticism. But I think that, as I said before, there are really important lessons from history for policymakers and historians on the subject of financial crises. Okay. Okay. So let me do the first thing is the evolution of exchange rate regimes. And again, I've written a ton on this stuff, on the gold standard and Bretton Woods. So you got these four regimes, and they evolved over time, and there was learning that took place, both with respect to macroeconomic policy and financial stability policy. So the first one's the classical gold standard. Okay, I'm not going to talk about the ancient stuff that Nathan's an expert on. That's the sort of predecessors to the classical gold standard. And there are a number of key sort of things, concepts that come out of the gold standard. The first is that most advanced countries followed a credible gold convertibility rule. Okay, I wrote a paper on this with Finn Kidlin a long time ago. They had to maintain convertibility of their currencies into gold at a fixed price. Okay. Secondly, they learned a rule for financial stability, the Bagehot's rule to lend freely, but at a penalty rate in the face of a big financial crisis. And they were, you know, if you look at the advanced countries' experience, they were pretty successful. I mean, not every country was as successful. The British were the most successful, but some of the other European countries did very well. The emerging countries didn't do as well. Okay. And so this is the story before 1914. Okay. Then World War I comes along, and the gold standard goes kapowie. It gets destroyed by the war. And then afterwards, countries, most advanced countries, wanted to go back to the stability of the gold standard. But it's pretty hard to do when you've got very high inflation, okay, and you've had tremendous changes in political economy. And the key thing about the gold standard period was that the suffrage was low, okay, and generally, if people were hit by, if there was a serious recession and there was high unemployment, people would move. They would migrate across from Europe to America. And so after World War I, it changes. The story changes, political economy changes, okay? The suffrage expands, the growth of labor unions. This comes from Barry Eichengreen. And so now, the sort of basic bedrock of the gold standard, which is exchange rate credibility, that's threatened because now central banks and monetary authorities are also concerned about the real economy. And so there's, in a sense, and so the goal of exchange rate convertibility at a fixed price, that becomes threatened. And so there's a lot been written about what happened in the interwar. It could be a whole speech for sure. It had these fatal flaws of adjustment, liquidity, and confidence. And as Eichen Green, again, I owe him a lot, the two of us are talking on the same stuff. It involves central bank cooperation. That sort of kept the gold interwar system going up. And also, this is the period of the beginning of the dual mandate. And so, of course, it all collapses. It all collapses starting with the Wall Street boom in the 1920s, and then some serious policy mistakes made by the Federal Reserve, a relatively new central bank that followed a doctrine called the real bills doctrine, which had some serious problems with it. And that led to them trying to kill the stock market boom with tight monetary policy. And what they succeeded in doing was not killing the boom, but killing the economy. Okay, and then mistakes that the Fed made during the Great Depression from 1929 to 33 of not preventing serious banking crises. Okay, and then the crisis in the US spread to the rest of the world through the fixed exchange rate gold standard. So other countries went through the same misery. Okay, and then the system collapses, World War II comes along, and again, the advanced countries and this time it was mainly Britain and the US, sort of said, we got to avoid the mistakes of the interwar. And so they set up the Bretton Woods system. And that's a compromise between fixed exchange rate, gold standard, and having floating exchange rates, which gives you monetary independence. And the system, again, is very complicated, all the attributes of Bretton Woods, but it actually gives you pretty good macro performance in the 50s into the 60s in terms of low inflation, stable inflation, and low and stable real performance. But the problems of it being on a pegged exchange rate, which evolved into something called the gold dollar system, is that the problems of the interwar came back. The problems of adjustment, liquidity, and confidence. And the key thing about Bretton Woods was that there was one center country, the US, and the rule was they had to maintain price stability. And as long as they did that, the system could work. But starting in the mid-60s, the Federal Reserve began following an inflationary policy, in part to deal with growing fiscal imbalances, President Johnson's Great Society, and the Vietnam War. And so the great inflation, in a sense, really led to the breakdown of the Bretton Woods system. Now, looking at financial stability, what happened was the Great Depression was blamed on the banks and the central banks. And that led to the creation of exchange rate controls, capital controls, these I mean by external controls, and significant domestic controls on the banking systems of each country. And also what happened is that central banks were blamed for the Great Depression, and so the treasuries began to dominate. You had something called fiscal dominance. So what you did get financial stability because banks were made, they couldn't take risks. So you got financial stability coming out of the Bretton Woods period, but you also got financial repression. And that leads to the regime we're in today, the managed float from 1973 to 2006. And when we think of that period, the first thing that happens is the great inflation. So the period from the mid-60s until the early 80s is one of high inflation in almost every country. And there are lots of reasons why. One is that the gold constraint of Bretton Woods was gone. And secondly was what I call flawed doctrine, okay, Keynesian doctrine, the belief in the Phillips curve, and fiscal dominance. And then tied into that is the loss of central bank credibility with high inflation. And so the first part of that period is one of the current period is one of bad macro performance. And it takes this Volcker shock in 1979 when Paul Volcker became chairman of the Federal Reserve in the US, and he followed a tight monetary policy, and to return to low inflation caused a very serious recession. Same story in Britain, in Canada, and lots of other countries. And you get to something called the Great Moderation, which is this period of very good macro performance from the mid-'80s until the early 2000s. Okay. But, so macro performance is great, right? But now we talk about financial stability, and then you find that financial instability comes back to the period before, like up to the 1930s, and you start getting banking crises again. Okay, and that's because you had inflation interacting with these various kinds of controls. And you get liberalization in opposition to that, which is driven by financial innovation. And the capital controls between countries are eliminated. And so what happens is that the system starts to get unstable. And one of the key things was this creation of this financial safety net. And so you do get banking instability, but it always ends with major fiscal resolution. So you don't get the lineups outside the banks and the banks failing. They get resolved. They get taken over and they get recapitalized. And then another thing that starts in this period is called too big to fail. Okay, that banks that are considered important enough to fail are saved. Okay, and that leads to the problem of moral hazard, to the fact that that banks, if they know they're going to be saved, they take more risks. And the public that have their deposits in the banks know that they can't lose their money because they have deposit insurance. Okay. So then we get to the global financial crisis. And there are a number of causes here. The first, I think, is U.S. housing policy, which people are encouraged, low-income people are encouraged to own houses. And there's a whole apparatus that's set up during the Great Depression with President Roosevelt and all the way through that period. Second problem is loose Fed policy. In the early 2000s, the Fed keeps interest rates too low. Not just the Fed, all the major countries do that. Okay, and that, in a sense, fuels a credit-driven asset price boom. And then the third point is lax supervision and regulation. That there's financial innovation taking place, and the financial authorities are just not on the stick. They aren't really monitoring it and dealing with the increase that occurred in leverage. And so you get this credit-driven asset price boom and a bust and a global financial crisis. Now, what happens in 2007 and 8 is you don't get a repeat of 29 to 33. You don't get the Great Depression because central banks had learned to be lenders of last resort. Okay, but you do follow other policies, some of which, unorthodox policies, may have threatened the credibility and independence of central banks. Also, you get a lot of regulation after the crisis, the Dodd-Frank Act in the US, Basel III. And again, so there's a major regime change that has occurred in the past 8-9 years. And that's all based on the belief that the global financial crisis was caused by financial sector imbalances leading to credit-driven asset price booms. And so the question I raise, okay, just sort of playing devil's advocate, are we going to go back to financial repression? Because it seems to be like a bit of a repeat of what happened in the 1930s. Okay. So that's my second point. Okay, and it's all going to come together later. The third thing is, I then say, well, what about financial crises? If you want to understand the link between the monetary and financial policy regime and financial stability, it's important to understand the record of the really most extreme kinds of financial instability, which are financial crises. And as I've been saying, the financial crisis problem, which was a big problem before the 1930s, has really come back in the second year of globalization since 1973. And the other thing that's happened is that the output losses that occurred before 1940, it seems like we're moving back to a world where they're just as big now or even bigger. And so because output losses of crises have gotten bigger, that explains why monetary authorities are so worried about financial instability, because it becomes very costly. So what I do is I'm just going to show you 3 or 4 pieces of evidence from my empirical work with Chris Meisner and others So the first thing is I'm going to show you is a picture here of financial crises. This is just showing you the incidence, okay, the probabilities of having a financial crisis across time, across 4 regimes: the gold standard, the interwar, Bretton Woods, and now. And there are a number of different colored bars. Why did I do that? Because there's been a lot of work done by different researchers with different definitions of what a financial crisis is. So I did work with Barry Eichengreen and Chris Meisner, okay, but Reinhardt and Rogoff did a famous book that used their own definition, and the IMF have used their own definition. So I just, rather than say mine's the best, of course I believe that, I put them all there. And as you can see, the picture shows you that obviously the interwar was the worst, okay, but that in the Bretton Woods there was nothing, okay, but that if you look at the recent period, it seems like it's starting to look a lot like the pre-1914, okay, that it's starting to look like the past. Second piece of information I look at is to show you that big financial crises are not just one country. There are lots of countries. They're global. And so I had to measure some work I did with a colleague at Rutgers, John Landon Lane, of just measuring global financial crises. So this picture, which sort of summarizes that research, shows you that there were 5 big ones since the 1880s. Again, and this is the big bars, the blue bars, show you the incidence, okay? And obviously the Great Depression is the biggest one. And notice that the one we have on the far right, which is today, I mean sort of the last 10 years, is actually in terms of incidence not as big as some of the ones even in the 19th century. The scale is just it's a metric, it is a metric of incidence, okay, and it's aggregated across different countries. So it just adds up across countries, these measures of the probabilities of crisis.
Also size?
Excuse me?
Also the size?
That's the next slide. This isn't the output loss. This is just incidence. Okay. And these were the countries that are in here. So you can show this is showing you. Again, this is based on available data. Okay, I'm not saying there weren't crises elsewhere. We didn't have the data. Okay, then we did this. This is the one that's really the key thing. What are the output losses? Okay, well, what we do is we look at the measures of output losses, the losses, the decline of growth below the trend. Okay, and we compare two periods. We look at 4 periods, but what we find in this picture, okay, this picture, again, it's on my data plus other people's data too, okay? What we find is that output losses were obviously the biggest, and this is percentage of output. That is the incidence on the vertical axis. We're obviously the greatest in the interwar period. But notice, and this is the thing that's kind of worrisome, is if you look on the far right, you see that, and you look at the data, the very last blue bar comes from the IMF. Okay, and that goes right up to 2012. It's starting to look big. It's bigger. It's bigger than before 1914. It's not quite, obviously, as big as the interwar, but this is why people really are worried about financial crises. Okay, and then another thing we did was we did a study to see what were the determinants of financial crises. We did a meta-study, Chris Meisner and I, of the whole literature on the determinants of financial crises. And what that literature, what that meta-study does, where we looked at every paper and what are the key things that come out, is that there are a lot of reasons behind financial crises. Absence of a lender of last resort, poor supervision and regulation, weak bank structure, financial sector liberalization, and credit booms. So these are the key things. The credit booms become more important in the studies that focus on the period since the 1970s. Okay, so that's just giving you the history. Okay, so then I wanted to have some fun here, and there's some people here who are maybe historians and not economists. So just give you some narratives, stories. And I picked out 12 famous financial crises in advanced countries. I looked at the UK, I picked 4 big ones, 1825, 1847, 1866, 1890. And the US, I picked a whole bunch. And then I picked Australia, which had a huge financial crisis in 1893. And then ones you know about. Japan in 1990 and the Nordic countries. I didn't put Israel in here, I'm sorry, because I know you had one in the 90s. Okay. And so what I do is I put together a table which kind of summarizes, you can't read the table, but basically it tells you what are the key characteristics of a crisis. You know, did it involve a currency crisis? Was it global? Was there a credit boom? Was there a central bank around? Was lender of last resort followed? Okay, what kind of banking structure did they have? Was there a fiscal resolution? Okay, so I put all these things together, and then, you know, and the outcome, again, it's hard to read, is it's pretty heterogeneous. Okay. So here are some pictures. I hope it works. Yeah. So basically, I start with the UK, and there's a big crisis in 1825, the first global financial crisis. It's associated with a lending boom to Latin America when they were freed from the Spanish Empire. And it involves a lending boom, a stock market crash, a banking panic, and the Bank of England does not act as an effective lender of last resort. Okay, so this is the picture for that. And then also in 1847, it's a railroad boom, and it's a stock market boom, and there's expansionary monetary policy, and a market crash, and the Bank of England failed to be a lender of last resort. Here's one, 1866. Now the key thing is, that's because a big bank took some big bets and lost. Okay, and the Bank of England did not act as a proper lender of last resort. The key thing to notice in these pictures is there are lots of people standing around looking worried. Okay, what happens over time is their dress changes, hats get bigger, smaller. Okay, but it's the same kind of story of people being really worried. Okay, this is the barren crisis of 1890, which again involved Argentina. Okay, terrible mess in Argentina. Okay, it was a debt crisis, and a big British bank had had lent money to Argentina. It became insolvent. But here, the Bank of England intervened and did something called a lifeboat operation. They gave a temporary bailout, okay, which was guaranteed by the government, and there was no panic in London.
Was it repaid?
Excuse me?
Was it repaid?
Was it what?
The guarantee. Was the guarantee?
There was a temporary guarantee, yes. The British government did a guarantee.
But the question is whether paid back.
What happened was it was paid back. Okay, yeah. They recapitalized the bank. The owners of Barings were wiped out. Okay, that was the part of the deal. All of their assets, their furniture, their houses were sold. Okay, there was not the kind of bailout we talk about today.
But I think the governor of the bank did illegal action bailing out, no?
He did what?
Anyway.
Okay. Okay, here's another one. Australia, 1890. This is a classic. This is a great story. There's a lending boom in Australian pastoral land, sheep growing land, financed by capital flows from the UK. Okay, there are these banks that are set up to funnel money to these companies that finance this land. And what they did was they went to England, and some of these banks were incorporated in England, and they fooled British depositors thinking that their money was safe, that these Australian banks, they gave them names so they sounded like British banks. But they were paying a much higher interest rate on their deposits. So what happened is terms of trade, which had been rising in the late 90s, starts to fall. And there's a huge decline in the price of wool. Land prices fall, the banks fail. The guys in England that lent them the money, they lose. So there's a sudden stop of capital, and Australia has a depression for 10 years. Okay. And then the US, and again, this story, some of you know this, before the Civil War, there were lots of banking panics. There was no lender of last resort. You had unit banks, no branch banking, and the system had lots of crises. Then they set up something called the National Banking System, which was to improve the payment system, but it didn't have a very good lender of last resort. And so there were some very big banking panics in that period. And again, the stories are the same, guys standing around. Okay, this is 1873, it's a railroad boom. Okay, it's involved with a lot of capital flows from Great Britain. And then there's a corruption scandal involved in this. The British pull their money out, sudden stop, big banking crisis. Okay, there's no lender of last resort. 1893, that's a story about politics, about whether the US would stay on the gold standard or go on silver. Okay, and that leads to capital flight from the US, leads to 2 banking panics, no lender of last resort. JP Morgan tries to intervene but doesn't succeed. And so then the worst panic of 1907, and again, this isn't a lending boom story. Okay, this is a story of a sudden stop after the San Francisco earthquake, which had led to a big payout by British insurance companies to the owners of all this property in San Francisco. The Bank of England sees capital flight, its reserves going down, they tighten, and then there's a crisis in the US, okay? And there's no lender of last resort, and it's a very big panic, and that leads to the creation of the Federal Reserve to sort of become a lender of last resort. And then this one is the famous one, 29 to 33, the Wall Street boom financed by equities and bank credit. And there are these big policy mistakes made by the Fed, okay, following the real bills doctrine, trying to kill the boom, and then failing to allay for banking panics. That led to the Great Depression. And one thing to notice, the panics, guys standing there, but now you got cars in here. Okay, so you get traffic jams and people. Okay, okay. And post-World War II, okay, now we have the regime changes. We've got liberalization, we've got controls taken away, okay, and we get new banking panics, and some of the key ones were Japan, which was a real estate boom and a stock price boom, and the BOJ basically doing a big bailout, but not restabilizing the macro economy. And the Nordics, liberalization of domestic financial system, removal of capital controls, and a lending boom. And then a bunch of crises in 1991, and they're fiscally resolved at great cost. And this is Lehman, this is post-World War II. Lehman Brothers, I won't go into the whole story, I've already told you some of it, okay, but it leads to a global liquidity panic. It's resolved by unorthodox lender of last resort policy and credit policies and intercentral bank policy coordination. And here, last one's the Euro crisis. Everybody knows about it. It's a debt crisis that feeds into a banking crisis, in part because the Eurozone countries are encouraged to hold sovereign debt of other members. And you get the banking crisis is resolved by a bailout and a bail-in by the Troika and Draghi's whatever it takes speech. So what does it all, let's put it all together. What does it tell us? It tells us that there's a lot of heterogeneity in the circumstances in which these crises arose. There were lots of causes. Okay. And the key things that come out was early in the period was you didn't have a lender of last resort. In later periods, it's fiscal resolutions, and then the story of too big to fail, and then the credit-driven asset price booms, which become important in the post-1970 period. Okay. And I talk a little about financial innovation and how these innovations, financial innovations that occurred in the post-1970 period, increased liquidity and leverage in the financial system, and that's created a new source of systemic risk. Okay. So the last thing I want to do before I summarize this stuff and wrap up the talk So the global financial crisis led to new perceptions about the causes of financial crises and new emphasis on the role of credit-driven asset price. So what I did was I asked 3 questions. What's the incidence of credit booms associated with banking crises? Do they peak? I use simple business cycle techniques. Do they peak before or coincident with a banking crisis? Secondly, what's the incidence of equity boom busts and housing price boom busts associated with banking crisis? Do they occur either slightly before or at the same time as a banking crisis? And then what's the relationship between these types of events and serious banking crises associated with deep recessions, the one with the big output losses? So what I did, and I'll summarize that very quickly, I won't go through all these bullets. So I work with my colleague John Landon Lane on this stuff, and we identified a credit boom following the approach of a paper by Gary Gorton and Ordonez from Yale. So we define a good credit boom as related to the growth of total factor productivity, like railroads, for example, or the internet. And then a bad one is one that ends in a financial crisis because the TFP didn't happen, it fizzled out. And so we used an identification rule that they followed, okay, and we used 2 databases for 15 countries as measures of credit. Okay, we used one from the World Bank and one we used from Jordan and Alan Taylor that goes back to 1880. Okay, and so I'm going to show you some pictures. So here all we did was we looked at the incidence. Okay, this is what Milton Friedman called ocular econometrics, and I was a student of him. Okay, so he said, you know, just look at the pictures. Okay, and the X's, okay, the X's are major banking crises, and the red circles are credit boom peaks measured one way, measured by Alan Taylor, and the other one are credit boom peaks using recent data from the World Bank. And the key thing that comes out of that is there is not too much correlation. Okay, the probabilities, the percentage of credit boom peaks that within 1 year of a financial is 3.75%, and the ones that preceded are 2.6%. So what the results suggest is that a credit boom induced big crisis, like the Great Depression of 29 to 33, okay, they're pretty rare. They come about once every 50 years. Okay, and so the question is, if that's the case, should you be changing your monetary stability regime based on that incident? Okay, we did. So the next one is to look at the relationship between housing booms and major financial crises. And we find that there's a relationship, okay, but it's not that great. There's more of a relationship, and we've all been talking recently about housing price booms. Okay, we did the same thing for stock price booms. There's less of a relationship. Okay, and then here we finally look at the relationship between credit booms and asset price booms. And again, you find there's some relationship with housing, but not much with stock markets. And so what the evidence suggests is that the coincidence between credit boom peaks and serious financial, they're really quite rare. It also suggests that the coincidence between credit boom peaks are not very closely connected to asset price booms, and most of the coincidence occurs in these 2 big perfect storm periods of the 1920s to 30s and the recent global financial crisis. And so then you get to this question of, well, okay, now the central banks are really focused on this. They're looking at leaning up against the wind policy. And the question is this something we should accept without any question? Should this new regime be accepted? And what I argue in here, and I'm going fast, is that it will probably head off a few minor financial crises. But much later down the road, you might even get a bigger financial crisis than 2007 and 2008. And there's an analogy here, okay, between research that's being done about natural disasters. In the paper by Myron Scholes at Stanford, he gives the analogy between, you know, firefighters putting out every small fire in Yellowstone Park in the US since the early 20th century, which, you know, to prevent forest fires. And what it does is it leads to the growth of underbrush, and then you get shocks, multiple lightning strikes occur, and you get huge fires. Okay, we're seeing that happening in California right now. Okay, and so the question is, if you do if financial regulators do the same thing, then you might actually dampen volatility, but you get greater risk taking and the risk of a major financial crisis. So let me wrap this up. I'm going to take 5 minutes, Jacob. What are the lessons from history? Okay, so there obviously is a link between monetary regime and financial stability, and it involved a slow learning process. And in a sense, there were these four major lessons, principles that comes out of that: credibility for price stability, macro stability, rules-based lender of last resort, and sound supervision and regulation. And there have been countries that actually did this. So Canada, where I originally come from, actually avoided banking crises altogether by pretty closely following these principles. And when you compare Canada and the US to adjoining countries in North America and look at their history, like I've done with Hugh Rockoff, okay, who was a classmate of mine, and Jacob Metzer, okay, we find that a key difference was sound banking structure and prudent financial regulation. Okay, so then we get to the recent period. The recent crisis was blamed, like the 1930s, on the banks and the financial system. That in the 30s, it led to a new regime of financial regulation and the elevation of the financial stability mandate to primary importance. The same thing is happening today. Okay, and in a sense, the assumptions are not that different on elevating the importance of financial stability policy to that of macro stability, to what the thinking was back in the 1930s. Okay, the empirical evidence I've shown you casts some doubt on this basic assumption. Financial crises are very heterogeneous, and moreover, serious financial crises with credit booms are pretty rare. Okay. And so the recent crisis might have been a rare one-off event. It may have been a perfect storm with multiple causes, like 29 to 33. And so then the question comes up, I'm just repeating in a sense what I said before, was should these rare events lead to a sea change in monetary policy and financial stability as occurred after the Great Depression? And what that strategy did was give us an era of financial repression, which did provide financial stability, but also set into play forces which led to unforeseen and eventually serious threats to financial stability. And that may have sown the seeds for the global financial crisis 80 years later. Okay, and so this current obsession with financial stability risks recreating some of the mistakes of the 30s, 40s, and 50s. Okay, and then I talk about some of these tools of macroprudential. Again, that may lead to some other problems. And so, in a sense, you know, I see this. I think I basically what I'm saying is that looking from history at of the interpretation today of the last crisis requires a certain amount of caution. Okay, and so it teaches us. The survey of the historical record on the connection between the monetary regime and financial stability teaches us that a knowledge of history matters. And if you're going to base important regime-changing decisions just by looking at the last crisis, you ignore the heterogeneity problem of crises. And so what history teaches us is the importance of relearning the details of the events of the past, and that often contains important and long forgotten clues to aid us in understanding the crisis of today. Okay, so that's my talk. Thank you.
one word, one keyword from their book is homogeneity, right? And they're basically saying it's the same story all over again. It's housing crisis, an asset crisis, and then private debt crisis, public debt crisis, and then everybody thinks it's going to take a short time, but actually it's very protracted, and takes many years until you come out of it, and it's over and over and over again. And there doesn't seem to be a major role to the monetary system or like different. I mean, basically, it's just one narrative of repeating itself. Now, we're probably looking more or less on the same events. There could be some, selection in that your sample is a little bit different. But how do you explain the different opposing conclusions that you come out relative to those of Robert and Martin?
Okay, well, again, what we've been trying to do with Landon Lane, and we did this in other papers too, is to emphasize heterogeneity. Okay, and I never quite bought the story in Reinhardt and Rogoff. I had problems with their database. I had problems with the narratives they had of crises. Okay, and so I'm saying that its heterogeneity is really important, and so you don't always get a repeat of the past. You get financial crises, but the reasons do change over time. And I think there's a story that comes out of their work and the recent work of Alan Taylor and Jordan and others, which tells the same story. There's credit, there's debt, you get this, overhang of debt, and you get a bank. It's not true. Okay, we've seen that in recent years, but it's not, and so that's the point I'm trying to make. And so if you believe it's true, then you're going to come up with the policy prescriptions we get today. But if you think there's some skepticism there, then you got to really take into account the heterogeneity problem. Yeah.
I think one of the interesting, I don't know if you were involved in this study, is Canada versus the US.
I've been very much involved in that.
As I remember. So it's quite interesting. I mean, the two Anglo-Saxon closed economy, monetary policy ran very much the same, at least in the last crisis, I don't know about the 1930s, and Canada avoided basically both crises. So isn't that tell us something that certain countries' financial regulations and, I don't know, whether I say economic culture is very important?
It's very important. I mean, so the work I did, I did three articles with Hugh Rockoff and Angela Reedish from Canada, and we did one in the 90s and early 2000s, and then one just 3 years ago. And what we find is that the Canadian the regulatory environment is totally different. And so from the very beginning, Canada had nationwide branch banking, and the U.S. had unit banking. Okay, there's a lot of political economy stories about that. So Calamiris and what's his name at Stanford, okay, Haber, they have a whole political economy explanation for that. I'm not sure I buy it, but there is definitely political economy. And that carries through. There's path dependence that carries through all these periods. And the fact that Canada had always a very, pretty tight regulatory regime. Okay, so during the last crisis, okay, the banks, which had become universal banks, had one regulator. In the U.S. case, you had, I don't know, 20 competing regulators. That was a big problem. Okay, even after the U.S. got rid of, allowed branch banking, okay, you still had these problems come up.
And if you just look at the debt ratios, Canada is probably as highly debt than...
Right. So some people say...
Wait and see what happens.
Right. So some people...
we're talking about two huge, and Europe is really contaminated.
Right.
England is fully contaminated, but Canada twice is not, and it's...
the BIS people will say, well, Canada is going to have a big crisis. They say it just hasn't happened yet. It's like, if you getting to the BIS, so I didn't talk about that here, but there's a subtext here. The Claudio Borio and Bill White before, they've been saying the credit boom crisis is going to come. They've been saying that for 40 years. Before that, it was Minsky. Okay, then it came. It happened. in 2008. And now suddenly we're right, see? But it didn't happen in all these other occasions. So why should I, you know, suddenly go along with their strategy? So this is this is the subtext of where I'm coming from. Yeah.
This is really a continuation on that. I think I want to hear your reaction to that. I think after looking for a long time in the last few years at the U.S. crisis, that many of those roots are political. In other words, and political, and has to do with the political culture. You know,
Populist culture.
Populist capitalism, well, I would say that there is a link between the political establishment and between big money. And just prior to the crisis, about half of the assets of the U.S. banking system were not regulated. And this was the consequence of a prolonged process of abolition of regulation that started at the beginning of the 90s, and it got to a sort of a scandal, let's say in the 2000 or something like that. And the conflicts that between the Republicans and between the Democrats about what to do with those people that didn't have their own homes and so on. Those conflicts were actually shifted into Fannie Mae and Freddie Mac, and they were encouraged to give bad loans in quotation marks, with the blink of the eye saying at the same time that the U.S. government is behind it. And my question is really, what do you think about this type of explanation? Because you sort of you had a lot of stuff, so you shied away from the political. But I believe, I don't know. I got convinced that the politics and the link between the political establishment and between big money in the United States is really a very important thing. Look at look at the list of secretaries of the Treasury and where they were before. They were in the financial community. And look how the bailout packages have been designed. Okay? And who is it, and how the financial package during the last crisis have been designed by somebody like Paulson, who previously to that was the chief executive of the
Okay. Well, first thing I should say is I always relish giving a talk at a conference, and I knew that Alex is going to be there, because I know I'm going to get this huge, long, story and then a question, and usually it's too difficult for me to answer. But I think there's an element of, there is a very important element of truth here. Yes, the U.S. story is one of political economy, and there's a very good reason why, if we go back to the 19th century, why they had financial instability is because at that time, there was this populist fear of the concentration of banking power. Okay, then what happened was later on, we got the Federal Reserve, and the Federal Reserve was a compromise between the populists and the people on the East Coast money centers. Okay, and that might have been one of the reasons why we got this big credit boom in the 1920s. Okay, but so there's always been this fight between the populists and the money people in the U.S. And I think you're right. I think that that it has shifted towards the money people in the past couple of decades, and that's been part of the story. But there's another part that I've been talking about, I gave in my talk, which is this kind of, almost this dialectic that goes on, whereby you have a series of bad regulations in place, okay, like unit banking in the U.S., Okay, plus you have a central bank that's had flawed policies. You get a huge banking crisis. Okay, then you get a populist coming in, Roosevelt, and he imposes financial repression and a safety net. Okay, because the problem they see is banking. We don't want any more, we don't want another Great Depression. That creates incentives to evade the controls, and that's what happens in the whole period of the post-war, starting with the Eurodollar and lots of other stuff that occur. Okay, and what happens is that, getting back to what Zvi said, when you have many regulators in charge of different sectors of the financial system, okay, that you don't really have anybody seeing what's going on, and you get this financial innovation, and then that feeds into politics, and they get rid of all of the controls. Okay, they get rid of Glass-Steagall, and they allow nationwide branch banking, but they don't create a financial regulatory authority, okay, a gross one that combines everything, that can deal with a new environment. And this was how I see it as a serious problem. In the Canadian case, again, so what happened was Canada went from, you know, banks that just were chartered banks to banks that took over the insurance business and the stock market, stockbroking, and they became universal banks. So what they did was they wrapped up all the regulators into one regulator, okay? And that regulator regulated the universal banks. And so Canada avoided the kind of crisis that happened in the US and the UK. Okay, the US, both countries messed up on the regulatory side. And sure, you know, you set up incentives and people are going to take advantage of them. But I sort of see it more as this dialectic as being more important than rich guys taking power and being friends with key politicians. I think that's part of it.